This show is part of OnePlace, a daily network of focused briefings across the stories people follow most.
Welcome to the briefing. We are looking at the massive shifts in tech, finance, and global energy markets that are defining the start of this week. Let's get right into the headlines.
Big software companies face an existential threat from AI.
Jamie Dimon warns of massive interest rate shocks ahead.
Oil prices climb as a critical shipping deadline looms.
Bill Ackman bids billions for the world's largest label.
Universal Music shares jump following a major takeover offer.
A billionaire plots a massive takeover of Abbey Road.
2 more pharmaceutical giants join the Trump RX discount site.
Energy infrastructure damage will throttle oil for months longer.
First, the software crisis. The giants of the software-as-a-service world are currently facing what some are calling a SaaS-pocalypse. Industry titans like Mark Benioff of Salesforce and Anil Bousri of Workday are grappling with a fundamental question. Will generative AI make their platforms obsolete? The stock market is already showing signs of deep concern, with Salesforce down 26% and Asana dropping over 50% this year. The core of the issue is whether companies will continue to pay for massive, expensive subscriptions when AI-assisted coding allows them to build custom, internal tools for a fraction of the cost. We are seeing a shift where vibe coding allows non-programmers to ship apps in minutes. If a business can use an AI agent to manage its own sales pipeline or human resources data, the traditional value proposition of these multi-billion-dollar software vendors starts to look incredibly shaky to investors and customers alike.
Inside these companies, the debate is intense. Microsoft executives are trying to project confidence, arguing that the rumors of enterprise software's demise are greatly exaggerated. Their strategy is to pivot toward managing AI agents that work across platforms, essentially making their software the orchestrator of this new technology rather than a victim of it. However, the reality on the ground is challenging. Salespeople are reporting meetings where chief technology officers openly ask why they should keep paying for these services, when they can just build the functionality themselves using new AI tools. This isn't just a theoretical threat, it's a fight for survival that is rattling credit markets and forcing a total rethink of pricing and product strategy. The next few earnings cycles will be critical as these legacy giants try to prove they can remain the backbone of the corporate world in an era where custom software is becoming a commodity.
Now to Jamie Dimon. JP Morgan Chase CEO Jamie Dimon is sounding a loud alarm regarding the economic fallout from the conflict involving Iran. He warns that the world is facing significant interest rate shocks that markets haven't fully priced in yet. The primary driver here is the skyrocketing cost of oil and gas, which has been exacerbated by the blockade of the Strait of Hormuz. Dimon points out that this isn't just about the price at the pump, it's about the entire global supply chain. When energy costs spike, inflation becomes much stickier, making it harder for central banks to lower rates. In fact, he suggests rates might have to go even higher to combat these persistent pressures. This has massive implications for everyone, from governments trying to manage debt to families looking at mortgage rates. Higher rates generally lead to lower economic growth as businesses pull back on hiring and consumers tighten their belts to cover essential bills.
Dimon's critique also touched on the geopolitical strategy, specifically noting the risks of distancing from global allies during such a volatile time. He emphasized that the outcome of these events could be the defining factor for the future global economic order. It's not just oil. The shocks are hitting byproducts like fertilizer and helium, which are essential for agriculture and high-tech manufacturing. We are already seeing disruptions in shipbuilding and food production. While Brent crude recently saw a slight dip below $100, it quickly bounced back to around $110, signaling that the market remains on edge. The Bank of England has already held rates steady due to this uncertainty, and economists are deeply divided on what the next move should be. Dimon's warning serves as a reminder that the geopolitical crisis in the Middle East is no longer just a regional issue, but a direct threat to global financial stability.
Next, the oil markets. Oil prices are hovering around the $110 mark as the world watches a critical deadline set by President Trump for Iran to reopen the Strait of Hormuz. This deadline has created a binary situation for financial markets. Either we see a diplomatic climb down that could trigger a massive rally in stocks and a drop in energy prices, or we face a major military escalation. European markets have actually turned positive recently, suggesting some investors are hopeful for a resolution. But energy analysts warn that the markets are far from pricing in a true dampening of tensions. In London, energy giants like BP and Shell have seen their shares pushed higher by the rising crude prices. However, the broader economic impact is starting to show. particularly in the UK, where business activity has hit an 11-month low. The risk of stagflation is rising as input costs for fuel and energy squeeze profit margins across the service sector.
The uncertainty is palpable across all sectors. While some stock indices are showing gains, precious metals like gold have actually retreated because the strength of the dollar and a potential for further interest rate hikes are outweighing gold's traditional role as a safe haven. The latest business activity data shows a considerable slowdown, mostly linked to falling consumer spending as people worry about the war's long-term impact on their household finances. If the deadline passes without a reopening of the strait, we could see another uneasy period of market volatility as traders try to gauge the next move from Washington and Tehran. The situation is incredibly fluid, and the alternative scenario of a deadline extension would only prolong the anxiety. For now, the global economy is essentially holding its breath, waiting to see if the flow of energy through one of the world's most vital maritime passages will be restored or if the conflict will enter a dangerous new phase.
Moving to Bill Ackman. Billionaire investor Bill Ackman is making a massive move in the music industry, with his hedge fund Pershing Square submitting a $10.9 billion offer for Universal Music Group. Universal is the undisputed titan of the music world, representing global superstars like Taylor Swift, Harry Styles, and Bad Bunny. Ackman's bid is a complex mix of cash and shares that would value the entire group at over $63 billion. This move comes at a strategic time for Ackman, as he is currently preparing to take Pershing Square public on the New York Stock Exchange. By securing a dominant position in the world's largest music company, he is positioning his fund as a major player in the content and intellectual property space. The offer highlights the enduring value of music catalogs in the streaming era, where top-tier artists generate consistent, long-term revenue that is relatively insulated from broader economic cycles compared to other sectors.
This is a developing story that has caught the attention of both Wall Street and the entertainment industry. Universal's roster is essentially a who's who of modern music, including Kendrick Lamar and many others who dominate the charts. Ackman's interest isn't entirely new, as Pershing Square has held a stake in the company before, but this full-scale takeover attempt represents a significant escalation in his investment strategy. The timing of the IPO for Pershing Square adds another layer of intrigue, as a successful acquisition of Universal would provide a massive high-profile asset to anchor the fund's public debut. Investors are closely watching to see how Universal's current leadership and shareholders respond to the bid. If successful, this deal would consolidate a huge portion of the world's most valuable musical assets under Ackman's control, potentially changing the landscape of how music rights are managed and monetized on a global scale as the industry continues its digital evolution.
More on Universal Music. The details of Bill Ackman's €55 billion offer for Universal Music Group reveal a strategy inspired by the likes of Warren Buffett. Ackman believes that while Universal's management, led by Sir Lucian Grainge, has done an excellent job with the artist roster, the company's share price has lagged due to factors unrelated to its actual business performance. Specifically, he points to the delay in a U.S. listing and the uncertainty surrounding major stakes held by the Bolloré Group. Since listing in Amsterdam in 2021, Universal's shares had lost more than a quarter of their value, but they jumped 11% immediately following the news of Ackman's proposal. Ackman is essentially betting that he can unlock hidden value by addressing these structural issues and utilizing the company's balance sheet more effectively. He's even looking to bring in veteran talent agent Michael Ovitz as chair to further strengthen the leadership team and navigate the complex world of artist relations.
To pull this off, Ackman will need to launch what analysts call a full-on charm offensive to win over the major shareholders, particularly the Bolloré family, who still control a significant portion of the company. There is also the matter of Universal's stake in Spotify, which Ackman believes investors haven't properly valued. By bringing Universal under the Pershing Square umbrella, he aims to provide the market with a clearer, more attractive investment vehicle. The move is a bold play for one of the big three record labels, which also includes Sony and Warner. Universal's catalog is legendary, spanning from classical music to modern icons like Adele and Drake. If Ackman can convince the current owners that his vision will finally align the stock price with the company's cultural and commercial dominance, it would mark one of the most significant private equity moves in the history of the music business, turning a Dutch-listed giant into a cornerstone of his new public investment firm.
Next, the Abbey Road connection. The proposed takeover of Universal Music Group by Bill Ackman also places a spotlight on some of the most iconic institutions in music history, including the legendary Abbey Road Studios. Universal doesn't just own the rights to the music, it owns the labels like EMI and Island Records that have shaped the industry for decades. The deal involves merging Universal with a newly formed blank check company set up by Pershing Square. Under the terms, current Universal investors would receive a combination of cash and shares in this new entity. Ackman has been vocal about the fact that the stock has languished despite the company's strong operational performance. He attributes this to the postponed plans for a U.S. stock market listing, which was recently put on hold due to market uncertainty. By taking control, Ackman intends to push through the changes necessary to drive performance and finally give the company the valuation he believes its massive catalog of the Beatles, Queen, and Taylor Swift deserves.
This takeover bid is a clear attempt to capitalize on the disconnect between Universal's cultural power and its financial market standing. The fact that the world's largest music company, which controls such a vast portion of global music history, has seen its share price struggle is something Ackman sees as a major opportunity. He is specifically targeting the uncertainty created by the 18% stake held by the Bolloré Group, suggesting that his transaction can resolve these long-standing issues. The scale of the deal, valued at around £48 billion, would be one of the largest in the sector. It represents a massive bet on the future of recorded music and the belief that a more aggressive, US-focused management approach can extract more value from these timeless assets. As the industry watches, the focus remains on whether the existing shareholders will see Ackman's offer as the best path forward for a company that is essentially the custodian of the world's musical heritage.
Now to Trump RX. The White House's discounted pharmaceutical initiative, known as Trump RX, is expanding with the addition of two more major drug makers, AbbVie and Genentech. This brings the total number of participating companies to 11. One of the most significant additions is the drug Humira, which is widely used for conditions like rheumatoid arthritis and Crohn's disease. For patients without insurance who currently face a list price of over $6,900, the Trump RX site will offer coupons that drop the price to just $950. An 86% discount. Genentech is also contributing by reducing the cost of the flu medication Xofluza from $168 down to about $50. These deals are part of a broader most favored nation strategy, where the administration negotiates with pharmaceutical companies to provide uninsured Americans with the same lower prices that are typically available in other countries.
While these discounts are a major relief for those paying out of pocket, it's important to note that they are currently only available to the uninsured or those whose insurance doesn't cover these specific drugs. The administration is currently working to integrate these deals with a broader Great Healthcare Plan to allow those on government insurance to use copays for these medications, though Congress has yet to take up that specific proposal. In addition to AbbVie and Genentech, the company Amgen is expanding its offerings on the site to include treatments for plaque psoriasis and arthritis. Since its launch in February, the TrumpRx platform has grown from 40 drugs to over 60 2-1 offerings. The White House is framing this as a critical step in lowering the cost of living for Americans, focusing on high-demand medications that have historically been prohibitively expensive for those without comprehensive coverage, even as the legislative path for a permanent healthcare overhaul remains uncertain.
Finally, the oil flow. Even if a ceasefire is reached in the Iran conflict, the global oil supply is expected to remain throttled for months. A new analysis from the Eurasia Group suggests that the damage to energy infrastructure in the Persian Gulf is so extensive that repairs will take a significant amount of time. Furthermore, shipping companies that operate the massive oil tankers in the region would need at least 2 months to resume normal operations after any suspension of hostilities. Currently, the Strait of Hormuz is virtually closed, with ship transits dropping from 130 per day in February to just 6 in March. This has led to a massive backlog, with at least 70 large, empty crude oil tankers currently anchored off the coasts of Singapore and Malaysia. These ships have the capacity to hold 100 million barrels of oil, but they are stuck waiting for the region to stabilize before they can even begin the 4-week voyage back to the Gulf.
President Trump has indicated that negotiations with Iran are happening in good faith, but he emphasized that reopening the Strait of Hormuz is a top priority. He noted the extreme vulnerability of the passage, stating that even a single actor with mines could shut it down. This reality has kept oil prices volatile, with benchmark U.S. crude rising to over $113 a barrel. The international standard, Brent crude, is also holding steady at around $110, which is a massive increase from the $70 range seen before the war began. The long-term nature of the disruption means that even a diplomatic breakthrough won't provide immediate relief at the gas pump, or for global industries dependent on stable energy costs. The physical and logistical hurdles of restarting the flow of oil through such a damaged and dangerous corridor mean the economic aftershocks of this war will be felt well into the summer.
That's the briefing for today. Join us again tomorrow for more focused coverage of the stories that matter most. Don't forget to follow the show to stay updated on every daily update.